Okay, in the world of trading, you've probably heard these two terms thrown around a lot, the golden cross and the death cross. I mean, they sound incredibly dramatic, right? They're often painted as these huge make or break moments for the market. But what are they really telling us? Let's decode these signals. This is the one question that every single trader, every investor is constantly trying to answer. We're all looking for that edge, that little sign that says, hey, pay attention, the tide is about to turn. Because getting it right can be a game changer, and well, getting it wrong can be painful. And this search for a holy grail has led us to create tons of technical indicators. But among the most famous are the golden cross, which supposedly signals a big bull market is on its way, and its evil twin, the death cross, which warns of a bear market. They seem to promise some clarity in all the chaos, but do they actually deliver? To really get what these signals are all about, we gotta break down what they're actually made of. And it all comes down to a really fundamental tool in any trader's toolkit: the moving average. A moving average is pretty much what it sounds like. It takes the price of an asset over a set number of days, like, say, 50 days, and gives you the average. The whole point is to smooth out all the wild day-to-day price noise. This way, you can see a much clearer picture of the underlying trend. Is it generally heading up, or is it heading down? Now, for a golden or a death cross, we're not just looking at any moving average. We're looking at two specific ones. You've got the 50-day moving average, which is like the sprinter. It reacts really fast to what's been happening lately. And then you've got the 200-day moving average. That's your marathon runner, giving you that stable long-term view. The magic, or maybe the warning, happens when these two lines cross paths. So, a golden cross unfolds in 3 acts. First, you've got a downtrend. The fast 50-day line is stuck way below the slow 200-day line. Then comes the main event. Buying pressure starts to build, and that 50-day line punches right up and through the 200-day. That's the crossover. And finally, if the signal holds true, you get a new uptrend, where that 50-day line often becomes a new floor for the price. All right, so we've got the blueprint for the bullish golden cross. Now let's put it head-to-head with its much scarier-sounding counterpart, the infamous death cross. This table really lays it all out, nice and simple. It's all about direction. For a golden cross, the short-term 50-day line moves above the long-term 200-day. That's your bullish signal. For a death cross, it's the exact opposite. The 50-day dives below the 200-day, signaling a potential downtrend. So one says maybe buy, the other says maybe sell. Seems easy enough, right? Well, in theory, yeah. But how this actually plays out is where things get really, really interesting. So you're looking at a chart, you see the lines cross. Now what? What do traders actually do? Well, it's almost never as simple as just hitting the buy or sell button the second it happens. Sure, some traders might jump in right away, but a lot of them are more cautious. They might wait for the price to pull back a little to see if it tests one of those moving averages as a new floor or ceiling. And this is the big one. Most experienced traders look for confirmation. They'll check other clues. Is trading volume surging? What are other indicators, like the RSI, saying? They want more evidence before they put their money on the line. Okay, so we've gone through the textbook definitions, but this right here is the most important part of our whole explainer. Is this signal some kind of crystal ball that tells you the future, or is it something else entirely? And here it is, the crucial detail. Remember how moving averages use past price data to calculate the average? Well, that means a golden cross or a death cross is, by its very nature, a lagging indicator. It doesn't predict a new trend. It confirms that a trend has already begun. A huge part of the move might have already happened by the time the signal even shows up. This is where your brain might start to hurt a little. If the signal is always late to the party, then what actually tends to happen after one of these supposedly scary death crosses appears? You might think the answer is obvious, but trust me, the data tells a very, very different story. Check this out. According to research from the asset manager Van Eck, looking at Bitcoin, the median return 12 months after a death cross was a positive 89%. Let that sink in. The signal that's supposed to scream, "Get out now," has historically been followed by some pretty incredible gains. So what on earth is going on here? The answer, it turns out, is all about context. A technical signal doesn't just exist in a bubble. Its meaning can completely change depending on the bigger picture, or what analysts call the market regime. So for example, if a death cross shows up near the bottom of a cycle, it's often a super late alarm. The worst of the selling is already done, and the market is already starting to heal. But
in a true long-term bear market, that same death cross can be a spot-on confirmation that, yeah, things are bad and they're going to be bad for a while. Context is absolutely everything. So this all leads us to the final, and honestly, the most important takeaway from all of this. If these signals aren't reliable fortune tellers, then what are they even good for?
I love this quote from Matthew Siegel at Van Eck. He puts it perfectly. This signal is mostly a trailing mirror. It's not a crystal ball looking into the future, it's a mirror reflecting what has already happened right behind you. So think of it like this. A golden cross or a death cross isn't a prediction, it's a confirmation. It's the market's way of telling you that a significant shift in momentum has already taken place. It's basically a snapshot of the recent past, confirming that the balance of power between buyers and sellers has already tipped.
And that's really the bottom line. The cross just confirms what the market has done. It draws a nice, neat line under a trend that's already in motion. But the real challenge for every single one of us, the multi-million-dollar question that no single indicator can ever answer, is always, so what happens next?